Okay, everyone, welcome back to another round of Principles of Banking. This time, Chapter 4 is where we are going to go. And after last week, this week is actually a pretty simple week. Chapter 4 deals with deposit accounts and not much else. So, should be a pretty good place to go. Okay, so without further ado, let's take it away. So, why do we deposit money in banks? Why do banks want money? This is what the book calls the deposit function. Basically talks about, why do we even do this? So banks want deposited funds because banks need money to lend out. And that's pretty much, the only reason they want deposits is because they need money to lend out. Once they have deposits, they lend the funds out and they have to pay interest to the depositors, which is a cost of money to a bank. So the only reason they want it is to lend. So why do customers want deposits? What's the purpose for a customer? Well, there's basically three things. There's safety. Instead of keeping cash in your home, under the mattress, or in a vault, you can have it in a bank where it's protected. Also, there are insured accounts. The Federal Deposit Insurance Corporation insures your funds so that if your bank goes belly up, you will get at least some of your money back. And then the third reason is convenience, and access to your money at a bank usually provides those things. So that's why we have them. So there's a few different types of deposit accounts. There are demand deposit accounts, or DDA accounts. This is your basic checking account. Interest earning accounts can be a variety of things. And then there's savings and time deposit accounts. Did you know, for instance, that banks can enforce a 7-day notice requirement on savings withdrawals? So really, for accounts that you're going to be depositing funds and then you're going to want access to them right away, the basic account for that is a checking account or a demand deposit account. Common account types. Most banks offer these, and you're probably familiar with them. Checking accounts, savings accounts. There's sometimes savings clubs, like Christmas Club account, where people can deposit money little by little throughout the year to sort of force them to save up money for Christmas spending. Money market savings accounts, which are basically just like other savings accounts, except they require a higher amount of money deposited, and they are limited in the numbers of withdrawals customers can take. Certificates of deposits are timed savings accounts. So you put the money in for a specified period of time, maybe 6 months, a year, 5 years, and you will earn a higher interest rate for doing that. IRAs are retirement accounts. Most banks will offer some sort of retirement accounts these days. HSAs are health savings accounts, and these allow people to save up money that is tax deductible with a specific purpose of spending it on health care. And there's also other types of education savings accounts, 529s, etc. Not really pertinent for this chapter, but they're out there. So as far as the services that banks offer in concordance with deposit accounts, these are pretty obvious if you think about it. ATMs, teller service, night drop, direct deposit, and then there's a myriad of other services that go along with it, but these are kind of the four big ones. And then the items accepted are usually cash, coin, and non-cash items. What are non-cash items? They might be bank wires, checks, money orders, cashier's checks, traveler's checks, things like that. So those sorts of things are what we see as being accepted by banks. Okay, so moving right along here. Ownership types. The various types of ownership for consumer accounts are individual, where you own your own account; joint accounts, where you and somebody else, typically a spouse or a significant other, are joint owners on an account. Interestingly enough, some credit unions offer accounts where there is a primary account holder and a secondary account holder. And it's not a true joint account because the owners are not equal. The primary has more privileges and so on with the account. There's custodial accounts for people who may not have the capacity to run their own personal banking. They have a custodian, and then estate accounts for when somebody passes away. There's a method to own and to take care of the assets for their estate. Commercial ownership types are pretty simple. There's a sole proprietorship, which is a business that's owned by an individual. There really is an individual because the business is run by the person, and their social security number is the business's tax ID number. There's partnerships where two or more people are equal partners in a business. And then there's corporate accounts. Corporation accounts, they cover a wide variety of businesses, from actual corporations, LLCs, nonprofit corporations, other types of associations like that. Okay, now one thing the book goes over here is the identity requirements necessary to open an account. Now, the Patriot Act from 2002 or 2001 has made it very difficult to get an account without at least two forms of ID. And they've made the penalties against bankers more stringent should somebody open an account without the ID types. So you may notice when you go to the bank, they're asking for more IDs and more verification, and it's kind of annoying. But unfortunately, we have to blame Uncle Sam for that one. He is fully in control. And then there's such a thing as called a customer identification program. And what this is a bank must have a system in place to track customer ID, keep records of what the ID numbers were, how we verified them, and if it's done incorrectly, the penalties, again, very serious for the banks that fail to do what they're supposed to do when it comes to these kinds of things. And then lastly, the federal government requires that the bank determine that the person opening an account has the capacity to manage the account and the authority to do so if it's a business or a non-individual account. Last but not least, depository regulations. Reserve requirements. Reserve requirements are the amount of money that a bank must keep on hand available for depositors to access on demand. And typically this is between 8 and 10% of the deposits that are on hand. Some banks may be a little higher. They may choose to be a little higher. Some may be a little lower, but the Federal Reserve can dictate how much each bank must keep on hand. Electronic funds transfers, there are specific laws, especially Regulation E, which is specific to the electronic funds transfers, their availability, and who takes responsibility for these things as they go through. Another regulation is Regulation CC, which deals with expedited funds availability. This regulation makes sure that your funds are available as quickly as possible, and typically they say next day. It's not always next day, it's usually within 2 days. So, usually it's the next business day is really what it is. So it may be the next day. If you deposit your money late on a Friday, especially in Alaska, your funds may not necessarily be available till Monday of the following week. So just a little thing there. Truth in Savings Act is also known as Regulation DD. Requires that banks give customers information and disclosures about interest rates, how their money will be cared for, what the method is for determining the average daily balance, what the annual percentage yield is, the important thing, their annual percentage yield, and bank must spell this information out for the customers. That's the Truth in Savings Act. And lastly is the FDIC insurance protection. The Federal Deposit Insurance Corporation is what the acronym stands for, and you'll see these signs up all over every bank you go to. Or credit unions will have NCUA, which is basically the credit union version of the FDIC in the United States. It's the National Credit Union Association is what NCUA is. And they provide insurance protection up to $250,000 per owner, per co-owner. There's a lot of different ways that FDIC protection can be applied. I'm not going to quiz you on all the myriad of ways that can happen. Just keep, for quizzes, tests, and etc., keep the $250,000 number in mind. That's the one you'll want to know. Okay, so wrapping up. This has been a good start to the semester so far. All of you have been engaged and active in the class. I'm happy to see that. Keep using the discussion forums. I read them all the time, so I do get your feedback if you leave questions up there or things you want to hear about. And again, if there's anything specific you want to talk about in the class or you want a special lecture on, let me know. I mean, these broadcasts are pretty easy to do, so it's not too difficult if you want to hear about something to do with credit cards or how different bank products work. I mean, we'll get to a lot of them in the course of the semester anyway, but if there's something specific you don't think is going to come up in the book and you do want to learn about it, I'd be happy to put up something special. So let me know, and keep up the good work, and until next week, we'll talk to you again soon.